Hey guys, Bob Hertzog, your real estate dad. I've got a special guest with me today. As you guys know, I do a lot of work with folks that are getting up there in years and/or their caregivers or adult kids that are looking after them. And it's coming up more and more in conversations that, hey, my folks are getting to an age where we need to start thinking about what our next move is there, or even my own clients or their kids are getting to that situation too. So I've always wanted to learn more about reverse mortgages, and it's something that obviously comes up during conversations, and I'm not very educated on it, so I thought I'd bring the expert in today. Kathy.Burns is a reverse mortgage specialist with CrossCountry Mortgage. She was referred to me by my lender partner, Lizy Hoeffer. Kathy, I appreciate you coming in today to kind of go through the questions that folks might have when it comes to reverse mortgages. And obviously, I'll have down in the comments all of Kathy's contact information. If you or someone you know is looking to do a reverse mortgage, she is your gal. This is what she's focused on. So, Kathy, I'll hand it off to you and let you kind of run with it here. And then at the end, or I might stop you during the presentation with any questions I can think of, but the floor is yours.
All right. Well, thank you so much, Bob, for having me on today. I greatly appreciate it. And I also want to thank Lizy Hoeffer for the connection to you. And I get super excited when realtors want to get educated on the program. It is definitely becoming more widely used and can just really make a significant difference in people's lives as they're moving towards retirement, needing supplemental income, or something we're going to talk about today a lot is the purchase program. So
Right.
thank you so much, and feel free to ask questions as we go along here.
You bet. Hey, just some house cleaning, literally. You'll see like some pipes sticking out of the wall down here. We had unfortunately, a big leak upstairs, and this is my first day where I haven't had blowers running in my house.
Oh gosh,
They've been drying everything out. So if you see things look out of place in my office, that's why. So go ahead. The
no
floor is
worries. Okay. All right. So, yeah, so today we are going to share information and hopefully clear up some myths on the reverse mortgage program. And the program was created, and the intent with the program is so people can retire with greater financial freedom. The program has been around since the late 80s. A lot of changes have happened with the program. And like I said, it's really becoming more widely used. So again, I want to give a big shout out to Lizy for introducing and connecting us, Bob, and super excited to share the information. So the reverse mortgage is essentially a tool to utilize your home equity and to move it into a financial asset along with other retirement assets such as IRA, 401k, portfolio, things like that. So we are going to focus primarily today on the HECM reverse mortgage program. HECM is the acronym that stands for Home Equity Conversion Mortgage, and that is the FHA program that is the more widely used program in the United States. So what is a HECM reverse mortgage? It's essentially a home equity loan similar to a HELOC. So some of you might be familiar with a HELOC in the traditional mortgage world, but the HECM has some unique advantages. It is for a primary residence, so it cannot be for second homes, Airbnbs, investments, anything like that. But it's important to understand that you, the homeowner, keeps ownership and keeps title. So title does not switch to the lender or the servicer, and you remain in control of the home. We are also going to touch on a little bit the refinance program as well. And a question frequently comes up is, do I have to declare that as income? Is there going to be a tax consequence? And the good news is this is a loan debt. So all of the proceeds from the loan, regardless of how you use them, are tax free. So that's a big plus. The minimum qualifying age for this HECM FHA reverse mortgage program is 62 years old. And I'll touch on the jumbo program in a minute. But again, for the FHA, it is 62. And the big wow factor on these programs is that there's no mandatory repayment obligation. Now, who wouldn't love to be able to get a mortgage without a monthly payment? I know I would. But it is very important that the borrower understand that they are still responsible for keeping current with property taxes, homeowners insurance, and the minimum property standards for maintenance. And that's true of all mortgages. All mortgages, you have to stay current on taxes or the fire homeowners insurance. Okay, and the HECM program is very safe because it can never be reduced, called, or canceled, regardless of what's happening in the marketplace, which can happen with some traditional HELOCs. So repayment is deferred until a maturity event occurs, which is essentially when the borrower permanently vacates the home. So it could be they might choose to sell their home, to move to a different location, or in the event that the last borrower passes on, then that would trigger the loan repayment.
Yeah.
It is,
Kathy, I just
yeah,
thought of something that I wanted to point out. When the one before where you say the HECM cannot be reduced, called, or canceled. And I wanted to share something real quick, just from personal experience. During the short sale days when the market crashed, there were a ton of people out there that had HELOCs in place where their line of credit was frozen by the lender because the market had taken such a beating. So that's a very important point. If people are considering doing a HELOC versus a HECM, is that the lender, if the market goes down significantly, we end up in a financial crisis, they can't say, oh, sorry, you don't get your payments anymore for your house because it's not worth what it was, right? So I
yeah.
just wanted to point that out because a lot of people immediately think of HELOC, but when you're in this age category and you meet these qualifications, that's where this would come in very handy. So
Right.
carry on. Sorry.
Yeah, and Bob, that really is significant and an excellent point you make because it's just very risky
Yeah,
for people that are relying on these funds at this stage of life.
that's right.
And I did also have customers calling me during, 2007 and 8, very concerned that their
Yeah.
first traditional HELOC was frozen. And they're like, is my reverse mortgage line of credit going to be frozen? And, I could excitedly tell them, no, the answer is no. It is guaranteed to be staying in place. And the line of credit portion will also grow for them, giving them even more access to available funds. So it's very safe, very low risk
Yeah.
on the reverse mortgage program. So thank you for pointing that out.
You bet. You bet.
Yeah. And then the next thing that, like I said, is very important to understand, and probably the biggest difference of a reverse mortgage compared to a traditional mortgage is what happens to the loan balance.
Hmm.
So, in lieu of requiring that mandatory principal and interest monthly payment, which is a real cash crunch for people in older age, the program allows the interest to be added on to the outstanding loan balance every month. So as a result, the loan balance increases over time. So it's a trade-off, no payment, growing loan balance to be paid off in the future. So again, we have the idea that we are using equity as an asset to give us that monthly relief of no mortgage payment. So the
Right.
kind of the fancy term for that is negative amortization. But
Hmm.
we do like to remind borrowers as well that with real estate typically appreciates over time. It can vary each year up or down, but over the life of the loan, we usually see a positive appreciation, and that does offset some of that growing interest and loan balance over time.
Yep.
Kind of in addition to what we were talking about earlier, how the loan can never be frozen, another very important safety feature is go back to 2008 or 9. If the loan was upside down at that particular time because we had an economic situation, that was almost a disaster. If the loan is ever upside down, FHA insures the HECM reverse mortgage program. They are responsible for writing a check for the shortfall. So you mentioned short
Hmm.
sales. And, with that short sale, while people might have been happy to negotiate a short sale, they were getting hit from the IRS with forgiveness debt tax consequence.
Yep.
So it kind of blindsided some of the people later on. We were like, oh my gosh, I may have negotiated $100,000, reduced payment to satisfy my underwater mortgage, but then they had to pay taxes on that 100 grand forgiveness debt. So with the reverse mortgage, which is very different, they are not responsible for any loan balance that may be in the red. FHA writes a check. And the fancy name for that feature is non-recourse. It basically means there's no other recourse other than the value of the home at the time of payback. So not
Yeah.
the value of the home when the loan was taken out. So again, if we have a free fall like in 2007, it still is the current value at the particular time of payback. So
Mhm.
another really important safety feature.
You bet.
Okay, so which borrowers are eligible? We already mentioned that for the FHA program, which is for home values for 2025 up to about 1.2 million, they are best suited for the FHA HECM in most instances. And the minimum age is 62. Now, if someone has higher value homes above the 1.2 million, we do have a lot of really great jumbo reverse mortgage programs, and that age is actually lower. The borrowers can be 55 years old. So it's nice to have that option if needed.
Okay.
So again, they must be living in their home as a primary residence, and they must stay living in the home 51% of the year. Okay, so to qualify as a primary residence. So we do look at some basic minimal income to make sure they can keep current on those property tax, insurance, and maintenance obligations.
Hmm.
Okay, and we also credit score is not a requirement, which is nice for the FHA program, but we do look at the most recent 24-month payment history.
Okay.
Okay, so I'm just going to reiterate again that within the two broad categories, the FHA HECM, you can think of that as the slightly smaller program. The jumbo, again, is the larger program for the higher value homes. And within both of those programs, we do have the purchase program and the refinance program. And it's very important to understand the purchase program is becoming a lot more widely used by realtors recommending it to their clients, but it's not quite as mainstream as the refinance. So we really just need to understand that on the purchase program, it is a full draw of the reverse mortgage loan to complete the purchase price. So
Mhm.
there is no future loan amount like for a line of credit or monthly disbursements or things like that. So I just want to make sure to really point out that differentiation between the purchase product and the refinance, because a lot of people are like, oh, great, I want to do a purchase, and then on top of it, how much can I get per month? But we are exhausting, just like in the regular mortgage world, we are exhausting the full reverse purchase loan amount to complete that purchase of the home. Okay.
Hmm. Okay.
So, how does the purchase program work? Again, emphasizing a full loan draw. And we like to compare it to an all cash purchase because when people are in this age bracket, it's really not appealing to them or may not be even financially possible to bring on a brand new conventional loan that carries that mandatory monthly payment. So a lot of times what they want to do is use all cash. They sell their departing home. They say, I'm going to use all cash. That way I don't have a mortgage payment and it's not going to be such a budget crunch every month. However, if they consider using a reverse mortgage purchase program, it still achieves their goal of not having that monthly mortgage payment, similar to that all cash, and they don't have to exhaust all of their cash from the sale of their house.
Yeah.
Sometimes they do exhaust all of it to boost up their purchase price, or sometimes they might, say, hey, I have $500,000. I only want to use 400 to buy a $700,000 home, and I'm going to keep $100,000, in my savings, for emergencies or supplemental income. So it's really flexible when they combine their cash down payment from the sale of a previous home, how much of it they want to use, and when they marry it with a reverse mortgage loan.
Hmm.
I'm going to show you an example in a minute of how it can really provide purchasing power by using the reverse mortgage loan. And some key points to remember: they need to bring in approximately 65% cash for the down payment. So, again, much larger than a traditional mortgage where it's typically 80/20, 80% loan, 20% cash down payment. So this is 65% cash down payment instead of 20, and the loan brings in about 35% to complete the purchase price. So let's
Okay.
let's take a look with real numbers of what this could look like. So here's an example of a gentleman who has $375,000. He may have sold a two-story home, doesn't want the two-story, hard on the knees. And so he's looking to move into a smaller one-story home. Well, Bob, if he comes to you and says, I have 375,000, what can you find me?
Yeah.
In today's market, it might be, well, not much. So you
Right.
would either have to consider taking out a traditional mortgage, again, bringing on that new mandatory payment, or if he combines his cash with a reverse mortgage loan amount, which would be 230 based on his age, he could now buy a 560,000 smaller one-story home. So we see the home purchase price here of 560. The program does carry an FHA insurance that is responsible for those two protections I mentioned earlier. And then we have the typical closing costs with the origination fee, title, escrow. So the total cost of this home utilizing this program would be 581,000. The reverse mortgage would provide a loan amount of 230,000. So his cash down payment would only be 351,000. So he still has a little left over. And what's the excitement? No mortgage payment for the rest
Hmm.
of his life. And he was able to use the power of the program to buy a $560,000 home with cash of 350.
Right. All
Okay.
right. Now, Kathy, if this guy doesn't have that 375, that's the other side of this that you're looking at, right? That he could basically borrow from his existing home that maybe he owns free and clear. I'm sure we're going to go into that, but
Right.
that this is just a scenario where someone's
Yeah.
got cash available uh,
Right.
to do that. Got it.
Yeah, absolutely. And I am gonna yes, go over an example of exactly what you're saying. So that's a good point.
Perfect.
And this example right here, though, as well, is very common.
Yeah.
I mean, I've done a bunch of purchases where, it's very common for people as they age to want to move closer to children because they
Yep.
might need some assistance or getting a little frail. In the
Yep.
example I gave, I've done a lot of purchases where the house is too big, the maintenance is too expensive or too much, the two-story, hard on our
Yeah.
joints as we age. So it's
Yeah.
very common where people, and maybe it was a house where they raised all of their kids and it's just too large now. Uh,
Right.
so yeah,
Right.
so they sell that, and we can, Bob, do contingent where they put an offer in on the new house that might be smaller, might be bigger, but while they're selling their current house, we are taking them through the approval to meet that new contract offer on the new house.
Right. And I think one important thing, and I'm sure you'll get to this in a minute, that you mentioned to me last time we talked is you end up talking a lot with folks, financial planners, to
Yes.
so that the financial planner can look at this as an option and advise their clients accordingly as to which program or what their best move is financially, moving money around and that sort of thing. So I think that's an important point too, that that's a very common thing for you to be on the phone talking to financial planners a lot.
Yeah, absolutely. And really, this is when customers do a reverse mortgage, typically it's really the last large financial decision they will make. And
Hmm.
I love teaming up, whether it's with their attorney. Divorce is very popular for
Oh yeah.
reverse mortgage. So each person, can have a home. But whether it's with their attorneys or financial planners or CPAs, and again, because what we're really doing, Bob, is using equity as an asset, and the financial planner is managing all of their assets.
Right.
And it's important to consider everything as a whole.
Right.
Not just a reverse mortgage or not just the portfolio or the IRA. So it's really, yeah, it works best when the customer has all of their teamed advisors communicating and looking at everything as a whole.
Perfect. Okay.
Okay, so now we're going to touch on the reverse mortgage refinance loans. Again, we still have that wow factor, that relief of no required monthly mortgage payments. And again, when I show you an example here in a minute, even if they're pulling out cash out of their house to help purchase another home, it still gives them the relief of not having a payment in order to achieve that goal. So we
Right.
talked again, the refinance program, of course, same thing, always has that non-recourse feature. They are never on the hook. If the loan should ever go upside down, because that FHA covers it. We do have non-borrowing spouse protections just in case one one spouse happens to be, say, 65, and let's say the other spouse happens to be 60, we can still do the loan, which is good news. They do base the loan amount on that younger spouse, so that 60-year-old. And the
Mhm.
reason is that spouse has the right to stay in the home for the rest of their life, even though they are not a borrower. So they have that protection, but as a result, the loan amount will be a little bit smaller based on that younger spouse.
Right. Okay. So both spouses don't have to be 62 or older, just one of them to
That is
qualify.
correct. That
Oh,
is correct.
good to
Right.
know. Great
But
point.
the loan amount will, so if a 62-year-old is married to a 50-year-old, the loan
Yeah.
amount is going to be significantly smaller because it is based on that lower spouse's age.
Right. Okay.
Okay.
Looks like we lost your video, Kathy,
Oh gosh. Huh.
and we want to see your smiling face if possible.
Okay. What is it that you're seeing?
I just see Kathy.Burns and a picture of the house. I see the like your opening screen. I mean, we can still hear you, so you can
Okay. Can
continue.
you see my screen?
Yeah, I can see your screen fine.
And can you see my video now?
No, I don't see you. I just see the screen with the house on it. So,
Don't know why that's happening. Okay, how about now?
nope, still see the picture of the
Let's
house.
go on. The most important part is the information.
Yeah. No, you're fine. That's fine.
Okay.
I can hear you.
Okay. So now I want to touch on the reverse mortgage line of credit. And this has some unique features, similar to a HELOC that we have mentioned a few times with some real advantages. So it is a line of credit. However, it is, like we spoke about, guaranteed under all market conditions and can never be reduced or taken away. And in addition, I don't believe there's any other program out there like this. The line of credit grows at the same interest rate that is being charged against the outstanding loan balance. Okay, so if the current rate for the outstanding loan balance is 7.25%, that line of credit is also growing at 7.25%, which in its compounded growth, which is very powerful. So if
Yeah.
someone had, $100,000 in the line of credit, the end of year one, they're going to have 107,000. Year two, they're going to have probably 116,000 because it's compounded growth, and it keeps growing every year, and that also is guaranteed. So
Wow. That's
again,
great.
real different, no freezing, continual growth. Okay.
Wow.
Um, Also, if customers for any reason wanted to make any payments into the loan, which is not common because that's not really the intent of the program, that does boost up also, in addition to the growth rate, boost back up the line of credit.
Got it.
And so again, as we're talking about the guarantee, um, a lot of times people are concerned, does my bank have that FDIC insurance, which is actually 250,000, per institution, per account. And we don't have to worry about that. People could have a $600,000 line of credit guaranteed, can't be frozen. So we don't need to worry about the cutoff limit of that 250 for the FDIC insurance. Okay. And
Perfect.
lastly, again, tax-free funds. Financial planners sure love that. That as they're supplementing their monthly cash flow through the reverse mortgage, they do not have to worry about paying tax on it. So
Perfect.
here's an example of a reverse mortgage refinance for someone that's looking to retire in a year. And he's always had a dream of owning and buying a small cabin or a condo near a stream. He's a fisherman in the mountains. So what he is considering doing is using the reverse mortgage refinance to basically secure a large portion of the purchase price of the second home. So if he puts, go ahead.
Sorry. No, I just coughing. Sorry.
Oh, no worries. So if he has a current home at 800,000, he would qualify for a $306,000 reverse mortgage under today's market conditions. And what he would do is sit that in that growing line of credit. So he would, after the FHA insurance and closing costs, he would have 280,000. But remember, it has that growth rate. So when he retires in a year, his new line of credit would have grown to $300,000. So he gained 20 grand by doing nothing other than just sitting it in that line of credit. So then when he retires, he finds a small cabin or a condo in the mountains for $400,000. He now puts $300,000 down towards that purchase price. And then he talks to his financial planner about whether he should utilize retirement assets to complete the purchase price, or whether he wants a small traditional mortgage loan with payment. But the good news is that he was able to finance 75% of it through the reverse mortgage refinance, taking equity out of his current home in order to buy this second home.
Mm-hmm.
Okay, so
Great.
very powerful tool there.
Mm-hmm.
Here's another example of a refinance to secure an assisted living home for a future move-in. So here we have Richard, age 76. He owns his home free and clear, which is $750,000 value. However, unfortunately, he's been diagnosed with a disease that's likely to advance with age. And he's really being smart and proactive and thinking, okay, I better, secure an assisted living home. And I know, these homes are very, busy and hard to get into. And a lot of times you have to get on a
Yeah.
waiting list
Right.
in order, especially if it's, the one of your choosing as opposed to just one that has an available opening. So
Mhm.
what he does is he does a reverse mortgage refinance, again, on the current home that he's living in, and he takes out the maximum lump sum cash in year one, which is $150,000. He has that to put it for a deposit to secure a spot on the wait list for when a unit or a home opens up. And then as soon as the spot becomes available, he can complete the purchase of that assisted living, the remainder of the purchase price by selling his home and completing the purchase of the new home. So it
Mm-hmm.
really gives him a lot of security of not having a mortgage payment and to be able to put down that deposit in order to guarantee himself a spot.
Great. So one quick question, Kathy. What determines the lump sum cash payout limit? Is
Yeah,
it a
that's a great question.
percentage of loan amount, or
It
how's it?
sure is.
Okay.
So many changes have been made to the program. This program came out, the HECM program came out in the late 80s. It was signed into law by Ronald Reagan
Mm-hmm.
with Congress, into Congress. And many changes for consumer protection have been made. We have the reverse mortgage required telephone counseling education seminar. And one of the additional protections is that HUD only allows on the refinance program. So we already talked about how on the purchase, they allow 100% full
Mm-hmm.
draw to be used towards a purchase, no restriction. On the
Mm-hmm.
refinance, it's 60%.
Okay.
So, for
Great.
whatever reason, HUD has determined that it is in the borrower's best interest to only utilize 60% with no restriction. You don't need to, give a reason why or what you're using the money for. But they allow a 60% utilization in year one. And then in month 13, it's wide open. So in this particular example, the max, again, after the closing cost would be 150
Okay.
um, available to do with whatever he wanted, which in this case, again, is for the deposit. And then here we go again with a line of credit, which would start at 138, but will be growing all of those first 12 months. Month 13, maybe it's 142,000 or whatever that compounding growth is, and he's free to do with it what he wants at that point.
Great. Perfect.
Okay. All right. You're asking great questions. So it's also really important to go over the myths because this is a niche specialty product and there is obviously an age requirement. So it's not as widely used like traditional mortgages for essentially anyone that is over the age of 18. So it's important to clear up what some of the confusion or the myths are there about that. So still the probably most popular myth is that the bank or the servicer owns the home and just lets the customer live there, which is not true today and actually has never been true. This
Okay.
is a regular mortgage that has a lien put on the house, just like a conventional mortgage. Okay. So the customer owns the house. There's no prepayment penalty. They can sell their house whenever they want. They control it. They are the owner. Okay. Uh,
Hmm.
Another myth, they can lose their home at any time. Again, not true. Just like traditional mortgages, the only requirement is to stay current on property taxes, the homeowner's fire or hazard insurance, and maintaining basic property requirements. Okay. Now, if they are not able to keep the property taxes, to pay them, or have insurance, I'm sure people have heard about lender forced insurance could be put on it. And if they are struggling, can't meet property taxes, they do have debt counselors try to assist the reverse mortgage borrowers, over a period of months. But if they just, for whatever reason, simply default on property taxes, then the loan could become due. Again, no different than a traditional mortgage. Okay.
Okay.
Reverse mortgages are only for people in financial trouble. That's very common thinking as well. And when I started 22 years ago, that kind of might have been, what people, the types of people that were utilizing in the beginning. But now it really, like I said, is the idea is becoming using equity as an asset. How can we marry the equity with all the other financial assets to give the customer the best quality of life and really to preserve all of their assets when used as a blended approach? So
Mm.
really, it has really gotten away from the quote unquote last resort loan.
Yeah.
Okay, and then heirs. This is a question I get asked by every single customer. And, am I saddling the heirs with the debt? Can I leave the house to the heirs? And the answer is you're not saddling the heirs with the debt because the house pays for the loan. And
Yeah.
again, if it's upside down, FHA pays for it. So there is no transferable debt to the heirs.
Mm.
However, it is not a requirement to sell the house to pay off the reverse mortgage debt. I will say that is the most widely used method because most children don't want to keep their parents' house, I have found over the years.
Mm.
But in the case that the children did want to keep the house, they can do their own traditional mortgage, cash out refi mortgage, pay off the reverse mortgage debt in one lump sum. There could, if there's life insurance, if there's other portfolio assets, the servicer doesn't care how they get their payoff. It's just simply a mortgage debt that they are obligated to pay off. Again, no different than a conventional mortgage. Okay, so really no difference there. Reverse mortgages, they have the reputation of being expensive and having hidden fees. Now, while they do have higher upfront costs, mainly because of that FHA insurance that
Hmm.
guarantees the line of credit can never be frozen and guarantees that if it's upside down, they're on the hook. Most people, when they understand those benefits, really feel like that expense up front is worth it. And also, really, any FHA loan, even in the traditional mortgage world, also carries that FHA insurance. But for my parents that had a reverse mortgage, I was happy, to have the loan on their loan pay that FHA insurance because I felt very secure that my mom had the line of credit for the duration of her life and care after my father had passed. So, but that is the main reason why there is a little bit more upfront costs is with that FHA insurance.
Kathy, I have one question I just thought of. When someone signs up for a reverse mortgage, is that a fixed interest rate for the life of the loan, or how does that?
Yeah, so we have fixed interest rates and adjustable. The
Okay.
adjustable interest rate is the one that's super flexible and allows the line of credit, the monthly income, cash flow, if that's what they want. So probably 95% of all the reverse mortgage loans is the adjustable interest rate because the fixed rate, all fixed rate reverse mortgages are mandatory cash outs. So one and done. The
Got
full loan amount has to be dispersed. And many times, or the majority of times, that doesn't make sense because why pay interest on the full loan amount starting day one when most of the customers like to use it sporadically over their lifetime as an income stream, draw on the line of credit when needed. So the adjustable programs also have protections, like there's a 5 point lifetime cap on how high the interest rate can go. And then, of course, with an adjustable, when the interest rates go down, their rate would flow down with it.
Right. And that's an important consideration right now in the lending environment or the mortgage rate environment we're in now with, a lot of speculation out there and no one has the crystal ball, but there's
Right.
a general feeling that rates are headed down over the next, year or two. So
Right.
that gives people a little bit more peace of mind. So,
Yeah, and the other thing I want to point out too is refinancing. It's just like, anyone that has a 30-year fixed rate 8%, if rates go down to 6, they're immediately jumping on a refinance
right.
to get that 8%. Refinancing reverse mortgages is also very popular. Again, you're not locked into the loan. So if we start
Yeah.
the rate today and it's at 6.5%, a year from now, if the rates are 5.5%, people can refinance it. They get a very large break and discount on that reverse mortgage and on that FHA insurance premium. So it's cheaper to refinance and they can take advantage of lower rates. So again, my favorite adjective for a reverse mortgage is flexibility. You're not locked into it. And just like any mortgage, always good to do a 6 month or a 12-month annual review to make sure you're in the best program for your particular situation.
Perfect. Perfect.
Okay.
Hmm.
Okay, so you won't qualify last Smith if you still have existing mortgage debt. This probably is the number one reason why people do reverse mortgages to get rid of that current traditional mortgage payment. So again, when someone is retiring, usually their biggest expense, if they still have a mortgage, is that monthly mandatory mortgage payment. So they do a reverse mortgage. Let's say they have a $2,000 conventional mortgage. All of a sudden, by us just paying off that mortgage, absorbing it into the new reverse mortgage, they immediately have an extra $2,000 per month, $24,000 per year for the rest of their life, or however many really term years are remaining on that current mortgage. So it really makes a big impact to
Hmm.
their cash flow to pay off an existing mortgage.
You bet. You bet.
Okay.
That's cool.
So lastly, we're going to go over loan payoff, which is important. So how is a reverse mortgage paid back? So again, want to focus on one lump sum. So the heirs can pay it off, like I just mentioned, assets, refinancing if they want to keep the house or selling the home. Selling the home is by far, the most common way that people pay these things off because most children, aren't interested in moving into mom and dad's home. So who has control? This is actually a myth as well. People think that the servicer, the minute the last bar passes away, takes over. Not true, because they're not the owners. So the borrower or the heirs, if the borrowers are just selling to move, obviously they are in charge of selling it. Or if the last borrower passes away, if the home's in a trust, obviously the executor or whoever is in charge of the home, they are in charge of selling it, not the lender. Okay. So what is the time frame? The time frame is 6 months for the heirs to sell the home, or up to 1 year with 2 3-month extensions that is approved by the servicing company. So at the 6 month mark, if the home is listed for sale and it hasn't quite sold yet, the heirs can request to the servicer hey, here's the MLS, we have it listed at a fair market value. It's not selling due to market conditions. Then the servicers, have the ability to grant an extension, which could bring it to a year. Okay.
Okay.
So a different situation, if the last borrower moves to a nursing home for an illness like a stroke or something like that, if they're out for longer than 12 consecutive months, then the loan does become due. Because statistically, if someone's out longer than 12 months in a care facility, they're very unlikely to return to the home. And in
Hmm.
order to keep this program viable, it is for a primary residence. Okay. But if someone, breaks a hip, has hip surgery, they're in a rehab for 6, 7 months, that's fine. They go back, after they've regained their strength and mobility, they go back to their home. No big deal. That's fine. If
Okay.
they try to, if they want to move to Hawaii, then that's going to trigger the 6 month payback. Because again, keeping in mind it has to be for that primary residence.
Kathy, one question there. So, if I'm understanding this correctly, the first situation where it's selling 6 months or up to 1 year, that would be a case where, let's say, someone passes away, the borrower passes away, the heirs or the family, whatever, would have up to 1 year to sell the home. Is that what you're saying?
I want to slightly correct that.
Okay.
The initial time frame that is granted is 6 months, which
Okay.
really is quite lenient. I'm not sure that other
Yeah.
traditional lenders, say, hey, we'll give you 6 months. They're like, hey, payments due. But reverse, because of the unique nature that this is, for retired people, they understand that usually you have to get mom and dad's house ready, clean it out, and so forth. They give an immediate guaranteed 6 months. Very important to communicate with the servicer. I actually just went through
Yes.
this with my own, paying off my own parents' reverse mortgage. And
Hmm.
I kept great communication with the servicing company. They were very lovely to work with. They said, what's your intent? I'm like, we're going to sell the house. We don't want to move into it. I had to provide them some basic documentation. And they're like, great, she passed away in January. They're like, let us know in June, if you need more time. So it's six
Okay.
months.
Yeah.
But if there's a circumstance, then you request additional time.
Got it. Got it. Okay. Yeah, and I would think it's important to really stay on top of things like homeowners insurance, your taxes, all that,
Right.
so that
Yes.
when your loved one passes away, a lot of
Right.
stress and everything going on, but you really do need to kind of focus on that. And what I'm hearing from you is that the servicer wants to see some activity. They want to see that you're moving towards that goal.
100%. And
Yeah.
you know what, and that is fair because again, to keep the program viable, they have set these guidelines and these parameters in years past. Kids are trying to say, oh, great, we're going to hang out in mom and dad's house for a few years, no mortgage payment and so forth. So
Yeah.
again, it's all
Yeah.
in the best interest of keeping this product viable for the consumer. And so these parameters are set up.
You bet.
Okay.
Good. Okay, cool.
That is it.
Yeah,
So
right on.
thank you so much,
That
Bob.
was no, that was so helpful. Every time I talk to you, I learn something new, it seems like.
Good.
The question I have, a lot of these seniors are, especially seniors, are getting hit left and right by all kinds of scam artists, and obviously loans are no different, whether it be reverse mortgage or anything. What are some red flags that when people get a phone call from someone offering some kind of a product like a reverse mortgage or whatever, what are some red flags that people need to look out for there?
Yeah, I mean, honestly, I really believe, like with everything in life, that referrals are a really safe way to go because, like in every industry, there's people that may not be looking out for the best interest of the customer, but loan design is very important. if someone is saying that they need supplemental cash flow, or money for care, the most wise financial decision or way to use a reverse mortgage is only use what you need. If you need a full draw for a purchase, great. If you're doing a refinance and you only need it incrementally or over time, only use what you need because that preserves equity, and does not accumulate interest as quickly. So really loan design, and we're dealing with very special customers. Every single one of my customers is over the age of 55 or 62, and just making sure they understand transparency, education, and just really hand holding throughout the process. And,
Yeah.
finding someone that's willing to, talk to the kids, also, to get them involved. Again, their team, their financial planner. So everyone's making the most wise financial decision on the use of this equity.
Yeah, there's so many. I mean, you watch any TV, and there's always all kinds of people on there promoting or trying to get people to call or go online to sign up for more information on their reverse loan product or reverse mortgage product and so forth. And the one thing that I can, and you probably know more about this than I do, but in real estate, the biggest thing is people will go to like a third party website, put in their information, and all of a sudden they're getting calls from 50 different real estate agents. And I'm sure in the reverse mortgage side of things as well, when you see that, just call this toll-free number and we'll give you all the information you need. A lot of times that's not the actual mortgage company or the servicing company or whatever you want to call it. It's a place to just get people's information so that they can sell those as leads to other companies, other
Right.
mortgage companies, and now you've got your phone ringing off the hook. So the one piece of advice, and you can chime in here, that I would give is be very careful about giving out your personal information to any of these companies because chances are you're just being fed into a lead pond where your name
Right.
and your information is sold to other people that might not be looking out for your best interest.
That's and again, that's true of everything, right? It's like you want to go, like I said, with referrals. When people come to me and say, I've read 5 hours on the internet, again, there's a lot of opinions, right? On Google or the internet.
Yeah,
But a lot of times those opinionated people don't have the true facts. Uh,
right.
I spend the majority of my time correcting the misinformation
Yeah,
that people, have searched on the internet. And they're like, oh gosh, well, they said the opposite, or that wasn't explained. So again, a trusted resource is way different than, especially on a niche product like this. This
yeah.
is not buying a car,
Right, right. The other thing, Kathy, is when they call you, and we talked about this last time, when someone calls you saying, "Hey, I saw you talking on the podcast about reverse mortgages. I wanted to get some more information." You're not just going to look at reverse mortgages. You're going to listen to their situation and say, "Here are some other options," because there's lots of other options. Just today we wanted to focus on the reverse mortgage, but there's a lot of other things that you may hear someone's current situation, what they're trying to accomplish, and say, "Wait a minute, we've got this product that might work better for you," right?
Yeah, absolutely. And I have to say, here at Cross Country, we have a phenomenal suite of products in a lot of products. And Lizy is so skillful and
Yes.
such a master at really hearing the customer's story and
Yes.
absolutely deciding what is the best product. Reverse mortgage is not for everyone. You know,
Yeah.
that's
Yeah.
obviously how it goes. So and we flip back and forth and refer back and forth. It's like,
Yep.
well, what I'm hearing is that because of your statements that you might be better for a traditional mortgage, you can afford a monthly payment.
Right.
Then Lizy takes over from there. Lizy might see in looking at the and hearing the customer story, you know what? You're going to have a better quality of life if you do a reverse mortgage with no mortgage payment. So, I mean,
Right.
we have such a great array of products here, and between Lizy and I and your
Yeah.
education, again, it's a team effort.
Yeah, absolutely. And I mean, just a perfect case in point last week, actually this week. No, it was last week. Gosh, all the days are running together. I had a client that thought he needed a reverse mortgage. And when he talked to Lizy, a bridge loan product actually worked better for him. And I mean,
Perfect.
that's what we're all about, right? We're all about just finding the best solutions for our people. And, and you guys, I know you and Lizy work hand in hand on that. So it's great. I have no anyone Lizy sends me to send my clients to, I'm happy to do it because I know that her heart's in the right place, just like yours and mine as well. Especially
Yeah,
for these seniors that are just getting
right.
they're
Absolutely.
getting hit left and right, and not just the seniors. A lot of times it's their caregivers, their adult children that are looking out for their financial interests and their
Right.
financial planner and everything
The
else.
sandwich generation. Yeah.
Yeah, yeah, exactly. So
Mhm.
this has been very, very helpful. I
Great.
really appreciate you
All
taking
right.
the
Thank
time
you
today.
so much.
Yeah, and folks, if you're looking for more information on the reverse mortgage, Kathy is such a great resource for it. She's super patient. She's not out to take advantage of anyone like so many are in this world today. So give Kathy a call and she'll help you. So thanks again, Kathy.
Thanks so much, Bob. I appreciate you.
All right, have a good one.